And now to land. Property investor and developer Stocklands results today were below expected. Net profit down 28% to $308 million. But the company still plans to meet its full-year outlook. And as white-collar city workers lose more and more jobs, Stocklands chief John Quinn is sticking to a clear strategy, shifting out of offices and into retail property and growing in the affordable housing market. I caught up with him after his results. Matthew Quinn, thank you very much for joining me.
My pleasure.
What I find really fascinating is your take on the housing market at the moment. You feel you've actually been through the low, don't you?
In our segment, yes, and that's the important point. For example, at the moment, anything to do with the top end, discretionary, is not good. Anything to do with affordability, where people are buying things for a reason and they can afford it, is actually quite good.
And that's very much your focus.
That's our niche, and that's been our niche for quite some time, deliberately so, because we want to have the most mass market appeal.
But one of the things that's tightening up, of course, is the credit and the financing for buyers of houses. Are you seeing this, and are you worried about a tightening going forward?
We have seen that as a trend over the last 2 to 3 years. This is nothing new. It's something we've had to deal with post the GFC. We haven't had any non-bank lenders actively in the market, so it's pretty much come down to the major banks now. I think personally they've taken a very responsible approach to lending. We see people who should get a loan, who are creditworthy, do get a loan.
Just while we're on banks, what do you make of this new wave of covered bonds?
Well, I think it's a good thing. It's something that's been mooted for some time. Whatever we can do to open up credit access for the banks is a good thing. But we've got to look at the cost, the overall cost, and what impact that has on the end consumer.
But what you're saying is if there is a big proportion of covered bonds that are actually issued, that might actually drip through to the customer.
That's the extent of my knowledge. I'm not a banking expert, but I just see that as an issue that's out there. Anecdotally and directly, we hear from our banks, we talk to them often, that their cost of finance is going up, and ultimately if they're able to protect their margins by passing that on to the end consumer, then that's potentially going to hurt our customers.
Anecdotally, a colleague of mine was saying that he thought that the Melbourne estates that you were now building, the lot sizes are actually a lot smaller than in Sydney. Is there a big difference?
There is, and there's a couple of reasons for this, and in Perth as well. Melbourne, the state government and the local authorities are very receptive to us doing this. They see this as a benefit because of the quality of what's built, what goes on the ground, and the fact that it's bringing people into affordable home ownership and stopping the consumers at large having to borrow too much money. There are certain parts of the country, Sydney is one, up until recently we have seen a change with the recent state government where to actually get a block of land on the market below 450 square metres, you know, it would be very, very hard for us to achieve the approvals when in Melbourne that would be pretty straightforward.
The offices and industrials market does look pretty dire. What is your outlook for it?
Again, it's very case-specific. Sydney CBD office space is pretty tough at the moment. White-collar employment is diminishing. There's a bit of supply. Vacancy is high. Lease incentives are high. Perth, on the other hand, is going very, very well. So it's very case-specific. The reason we're making this shift is fundamentally because in retail we know we can add value through development.
And you're still confident given how soft the retail market is becoming, because people talk about a structural change in the level of the Australian dollar. You've got the online threat.
Again, it's all about the segments that we operate in. We are, as we are in residential, we are in affordable, needs-based centres, a lot of them in regional areas where we are the main game in town. What it means, though, is because we are focusing on a product that is needs-based and affordable, our sales rates are much higher than those that are in disposable, discretionary areas. For example, in the last 12 months, the comparable growth in our retail sales in our small shops was 4.5%. The equivalent number that came out of the ABS the other day was 0.2%. So we're significantly outperforming the broader market because of our focus on that mass market segment.
Your shift to needs-based, to affordable housing is a major repositioning, and it's one that obviously you're in for the medium to long term. That says to me that you're expecting this economic climate to stay like this for some time.
Well, I am, but we actually started this about 5 years ago. Interestingly, we actually started our affordability strategy in residential in 2008, really before the GFC had happened, because at that point in time, housing affordability was actually more of an issue than it is now, because interest rates were so high. So Bit of luck, a bit of judgment. We actually focused on this affordability strategy for a different reason, but it's now paying dividends because of the overall economic conditions, the access to credit and the downturn in discretionary spending. So bit of luck and judgment, but we seem to be in the right zone at the moment.
You do indeed. Matthew Quinn, thank you very much for joining.
My pleasure. Thank you.